Hello, everyone. My name is Patrick McCarthy, and I'm the Executive Director at Veal Farmers of Ontario. Welcome to VFO's Managing Risks Mastering Markets on Demand webinar series and live event recordings. Tailored for grain-fed veal producers, this series will deliver expert guidance to help you understand market trends, manage risk, and strengthen your business. Joining us today from the Ontario Ministry of Agriculture, Food, and Agribusiness is business analyst and cost of production specialist John Molenhuis. With calf prices at unprecedented levels, knowing your cost of production is as important as ever. Today, John will work through the process of calculating your cost of production and highlight the impacts to the changes in market prices and production costs. Please welcome John.
Okay, very good. All right. Thanks, Patrick, and thanks to Veal Farmers for inviting me to be part of the webinar series here. Now, I know we had a recorded webinar a number of years ago when actually the cost of production tool was updated. It hadn't been updated for quite a number of years, so that kind of prompted the uh, the need to have a session that we had a number of years ago. So I'm going to try not to cover all of the same ground that was covered in that session, because I actually seen that you can access that session in the Veal Farmers archives of the videos. So I do want to talk a little bit. We are going to talk about the COP tool, but we're also going to be talking about another tool that's been developed to help farmers calculate cost of production. But I want to spend maybe a little bit more time on sort of the analysis piece of it, sort of the impact of changing prices and how, what factors have big impacts on that cost of production and on the profitability and the economics of feeding veal calves. So I want to spend probably a little bit more time on that. The original session a few years ago talked a little bit more about sort of the mechanics of the budget and the input and the format of the budget. So I want to talk a little bit more sort of about the results of it and the analysis and using it for analysis and trying to help you make decisions on the farm. So that's how we'll approach today's session. So like I say, we're gonna spend the bulk of the time looking at the tools themselves and just spending a little bit of time up front here. Some of it's a review of what we talked about last time, but just talking about some of the cost of production approaches. And then we do have the cost of production veal budgeting tool that we updated with the 2025 data that we're going to talk to first, but then we also do have another tool that I wanted to highlight that can help producers and farmers look through and calculate the cost of production based on their information. So we're going to be, again, spending the bulk of our time sort of walking through the worksheets just to give you a sense of and the flavor of what those tools are and what they can do for you. So we'll take that approach. And so when it comes to cost of production, obviously when we did it in 2019, we hadn't done it for quite a number of years. So, that was kind of the impetus and what was prompted for the session. And the prompt for an update this year was of course, so the biggest factor is livestock purchases and calf prices that we're seeing now, which is just unprecedented levels. So we're seeing livestock purchases commanding such a large portion of total farm costs for a veal operation. Now, then, you see, livestock purchases were 13% in 2019, and that was at about 100, I believe it was $130 a calf, if you can believe that we're at that level at one point. Because now in 2025, the average was closer to 1,200, and I know now we're north of 2,000 in 2026, so that livestock purchases slice of the pie is going to be even bigger. It'll probably be in the 60 to 65% range now in 2026. And then feed would then drop as a portion of that. The livestock purchases and feed are going to be the big components of veal cost of production. And we know that, but it's a bit striking of how big that livestock purchases change has been just over the last number of years here with calf prices. And that's not to say that the other costs have gone down. Like these other costs besides feed and calf purchases are all those yardage costs that we call them. You can bundle them all into a yardage cost. We got them individually here. It's not to say those costs have gone down and that feed has gone down. Feed costs from 2019 to 2025 went up 20% and 22%, the yardage costs went up. So those costs have gone up, but just not to the magnitude of livestock purchases where we see, calf prices 10 times higher than they were in 2019. So that's really, kind of prompted the impetus to have an update on these and have some tools available for farms to know what their cost of production and work with it and try to manage and control those. So that's was one of the main reasons why we're going through the process of the update and the session today. And so we talked about this in the last session, but it was, just some of the two main approaches is using a production system approach, which is more the production practices, mapping out what the production practices are for the operation, and a little bit more about what the physical production factors are that go into producing veal calves. So the feed rations, health protocols, what feed facilities you need. So it's really about what do you do and what do you need to do them. So what are the production practices and what are the investments? What are what is the labor, land, and capital that you need to be able to do those? And then on the historical data side of things, it's more how you did. Tends to be a little bit more looking at past performance and give you an idea of sort of what your average cost of production is for your farm, where the production system approach tends to be forward looking, where you're mapping out that production system and then looking forward to say, okay, what happens if market prices change? What happens if my corn price is this versus that? And you can make some of those changes and look at some of what, changes in practices, what those impacts are. That's so the biggest value in the tool itself is being able to make those changes, and it has those production practices in there as far as the amount fed, the number of days on feed, and some of the average daily gains and those kind of production factors that feed into those cost of production numbers. You can then make some of those changes where the historical data is more sort of looking at past performance, and not to say that the historical data can't inform some of the production system, because certainly, especially when you look at some of the fixed costs or some of the indirect costs that beyond feed and livestock and on the crop side of things, the seed, fertilizer, when you're looking at fuel or repairs, what are some of what are some of your numbers, because those tend to be a little bit difficult to come up with on a enterprise basis, because they're not directly tied to the production of a specific enterprise. It's just shared across several enterprises, but historical data um, can be help to inform some of the numbers that's used in that production system, the budgeting tool side of things. So, and it can be a combination of these as well. If you think about the risk management program, it actually uses a combination of these two approaches. So that, for livestock purchases and like calf purchases and the feed, they're using a production system approach of tracking calf prices and having a set feed ration and, average daily gain, typical average daily gain numbers that are then put together to form, using more of that production system approach, but then the yardage costs, all of those other costs are more on a historical basis and indexed up using some of the income and expense information that they have with the income database that we have. So it can be a combination of the two. And like I say, the VLCOP tool was developed and it is using that production systems approach. And we have a relatively new tool, this Farm Financial Analyzer, that allows producers or farmers to, put in their own income and expense information from their financial statements, from their income tax forms, and allows them to get to a cost of production based on the format of of a typical financial statement. So we have both of those tools, and we'll walk through those today. So on the production system side of things, just to elaborate a little bit more, it is more about the physical aspects, the production aspects first. It will get down to a cost of production, but it's more about, what are, especially on things like, the direct input side of things, what is the feed that you're and what types of feed are you feeding? How many days are they on that feed? How many head are on that feed? What is the weights coming into the operation, weights coming out, so you can get some of those average daily gains, calculations, and then sort of what are the labor requirements and what are the building and equipment requirements for the operation. And for the cost of production tool for us, we use or we take a bit more of an economic cost approach, which means that we're using market values for feed. We're estimating what the total operating labor hours are for the operation and applying a market labor rate to that, regardless of whether it's your own labor or hired labor, and having an interest on investment calculated on your capital requirements, even if if you have a portion that's financed by yourself in equity and some partially financed with bank financing. We're applying an interest and investment on that portion that you've invested as well. So it is more of an economic approach versus a cash base approach where you look at the cost of producing homegrown feed, or just looking at the hired labor component versus how much labor is actually needed. You're just looking at the cash hired labor components and then maybe just using the financing piece of the interest cost. So, two approaches from the production system approach, but we're using more of that economic approach, trying to apply an economic cost to these. So you'll see that, and we'll talk about that when we get to the tool. So it is more about, the physical amounts, production factors first, and then applying those input costs and getting to that cost of production. So it does need good production records in addition to the financial records. So especially things like on feed, you need those cost of production or those production numbers or the amounts fed and days on feed to be able to come up with some of those production systems. And feed costs will then be a big component. It is a big component of any livestock operation. So it's going to be a significant factor for the veal. And we saw that in the charts that beyond calf purchases, the feed cost is the next one. So it is one that you perhaps have a little bit more management control on versus the calf price, because calf price is more driven by is more driven by markets than something that you can personally manage from that side of things. So feed can be one of those areas that you have a little bit more management control on it, and it will likely be a portion of purchase feed, which is then strictly the cash costs that you're paying for those free fees. But then how you handle those homegrown feeds is getting back to that economic approach versus the cost to produce approach. The economic approach is then saying, okay, we're going to charge a market value for that homegrown feed to the veal operation for the corn that I'm supplying to the veal operation. So you need to make a decision on whether you're going to use the cost to produce value for homegrown feed or the market value for feed in those. And feed costs are going to be a product of both the feed prices that that you're paying for the feeds, as well as the amount you feed. So then that's when all these production factors come into play, and these are probably well known to you when you're tracking these production factors: average daily gain or dry matter intake, feed conversions to in a way of managing the feed costs. You're wanting to make sure that you're being as efficient as you can in your feed ration, so you're getting the minimum number of days on feed and reducing that so that the amount fed is less. And so then that directly translates into lower feed costs. So knowing those production factors are important on the feed side of things, and feed being a key ingredient and one of those ones that you probably have, one of the most management control over. So it is a key one to track and manage. Everybody knows that, but everybody does it a little bit differently, and it's important to have a good sense of what that is for your operation. When we're looking at just on the second cost of production approach, which is the on-farm historical data, you're looking at whole farm income and expense data that you're starting with, and then you've got to enterprise look at it on an enterprise basis. Typically, most farms have more than one enterprise, and then need to go through some allocation scheme to get to the veal cost of production, and that can be some of the main tripping points of getting to from whole farm to enterprise basis, is that allocation of trying to figure out what costs are associated strictly with the veal and what are some of the other costs that are involved with some of the other crops. And it could be distinct crops or distinct enterprises. Like you could be growing soybeans and canola that are just sold as cash crops and not involved in the veal operation. You could be growing corn that is then put through the livestock operation. So you could have enterprises like homegrown feeds that are, more cost centers to the livestock enterprise, where there could be um, other enterprises that are just distinct and separate from the veal enterprise. So you have to go through some kind of an allocation scheme to put those through. And the direct ones are simple. Calf prices are going to be in the veal. The purchase feed for the veal is going to be to the veal. But when you get to things like fuel and labor and machinery repairs, you have to come up with some kind of a way to say, okay, well, how much goes to veal, how much goes to corn, how much goes to soybeans, and it can get a little bit more difficult. So it is a bit of an art versus and a science to get to that point. And and so, like I say, it's some of the main tripping point is this allocation piece. So these are just, some suggested ways. Probably the most common allocation way is on a percent of sales. So if veal is 60% of your sales, 60% of those overhead costs are allocated to the veal enterprise. But the other ones, depending on the expense itself, you know, interest on operating capital could be on the percent expenses that are veal related. The amount of time you spend in the veal operation can be how you allocate the hired labor portion to the veal, and equipment costs like fuel and machinery repairs, the depreciation. All of those costs could be based on, some assessment of how much is used by the veal operation. And like I say, it's as much an art as it is a science. And this can be fluid. You can be, you're trying to, especially in that first year where you're not really, you really haven't tracked it this way before. So you have to come up with some kind of an allocation, and then you can review it at the end of the year, whether it makes sense, and maybe make some tweaks um, as you go through to make it a little bit more reasonable. And at the end of the day, it just has to make sense there's not going to be any one allocation method that's going to apply for every enterprise or apply for every cost. It just has to make sense for the specific enterprise and the specific cost that you're looking to allocate. So it is a bit of a process, especially that first year to get to there. But once you've got that set and you're happy with it, then you can keep on tracking that year over year. If things don't drastically change on your operation, you can keep those allocation that is, and it makes the year to year comparisons, easier to do. So let's now look. We do have the cost of production resources that we have on our website, including the grain-fed COP. But we've got quite a number of other crop and livestock budgeting tool spreadsheets that are available. And if you're looking to map out some of the costs for those homegrown feeds, we've got different forage and different grain and oilseed crops that are available there as well. And we also will look at that farm financial analyzer, but we've got other publications and data like the custom rates that can help put together and inform some of the costs that you're putting together for your operation. So we got those tools and resources available to you. So for the next little bit here, I just wanted to look at the actual tools and walk through the tools, because that's sort of the main reason that we wanted to look at some of these. So first off, let's have a look at the here's that grain fed veal budget that we kind of revamped and updated back in 2018, 2019, and then we did an update in 2025. So this is we took sort of the average costs and the average market prices for 2025, and we based it, especially on the livestock purchases and the market prices and the feed rations on the RMP model, which was very close to what we had in the past as well. But we're still using that 650 head operation, and it still have that ability of doing two different production systems, if you will, like a two-stage production, or if you're buying in preconditioned, or it can be a combination of the both. But it is looking at doing an annual production. So it's mapping out sort of on an annual basis, not on a lot of cattle basis. So it's working at trying to get to what sort of an annual production basis for the operation. And I'll only be talking about the stage one and stage two scenario because that's what the model is compared to. But you do have the option to do the precondition. So obviously the big changes in this is that, you look at the expected purchase price at 11.85. That was the 2025 average. And like I say, it was about 130, I believe, in 2019. So almost 10 times higher now in 2025, and certainly higher than that now that we're looking at prices in 2026. But this market price also had a significant jump. I think it was $1.30. Um, uh, yeah, oh yeah, 136 was the market value back then. So even at 11.85, we see the return per calf was $13. Where in 2019, the return per calf, based on very similar scenario here, was minus 99. So minus basically losing $100 a calf at $120 a calf versus 11.85. So a big piece of that is that market value. So you need to always be you know understanding and looking at the dynamics of the two to make sure that you're getting a good sense of what the economics are and looking for the veal operation, because sort of knee-jerk reaction, how could 11.85, how could you work through that, and that market value is going to have a big factor in that. So those are the big changes here. But just want to look again. Here's that painting that production picture for the operation. So mapping out the average daily gains and all of those, that production picture, the production factors, mapping out all of those. And then, the risk factors here, thinking about best case and worst case rates for some of the significant risk factors in the operation, just to give you a bit of a sense. And you see, even at $2,000, a pessimistic price, that's, not even where we are today. Like I think the last week's average was 2,200 or something. Certainly north of 2,000 is what we're seeing on the calf prices. So certainly big differences on some of these factors. And so, as far as the budget goes, it'll map out the revenues, and then feed being a significant one. We've got, a space here to calculate, all of the amounts fed for the prices paid for those to get to a feed cost, and mapping out the calf, and working through all of the cost of production values for these, and these have all been updated with the 2025 data on here. So you see the margin that's left after feed, calves, and health and labor, $400 per calf sold. So that $400 is left over to pay all of those yardage component pieces that are still left to pay. And then you can calculate all of these. You can put, a total annual number in here, or if you think more in dollars per calf, you can enter them in there. Just keep in mind that if you do enter, something, you've got marketing fees of, $20,000, you know, it will ignore the dollar per calf if you enter anything in here, but if it's zero, then it calculates it based on the dollar per calf. So just something to keep in mind. But then you got some of these other areas here to calculate all of the total cost of production for the veal operation, and we talked in detail on sort of the process and the format in the last presentation here, but we didn't talk an awful lot about the sort of the reporting or some of the the summary pieces. So a big piece, of course, is trying to get to that, what is the expected net revenue, and so there's that $13 a calf sold, which translates into about $8,000 a year. Keep in mind as well, we talked about the economic costs. So in here, we have an operating labor, um, the total amount of labor required for, or estimated required for the veal operation, and apply a labor rate to that. We have market values for feed. We have an interest on investment portion here that is calculated. So that's on equity and financed capital. So it applies to those as well. So looking at that number, this is the return then for your manager. We don't have a management component in here. So this will be your return to management, but you have a return to capital, a return to labor, and a return on those homegrown feeds built into this already. So this margin then is then the return to management piece. So if you're looking to do it a little bit more on a cost basis, you can do, your loan financing portion here, and you can have labor portion. You can just your paid labor in here to get to a cash amount for that labor. And then on the feed side of things, these costs can be on a cost to produce basis, the dollar per ton, you can do it on a cost to produce basis. And then you can see, okay, what are my returns for my labor and for my capital investments and for my homegrown feed. So then you can do that two ways. So that just to keep in mind and something to be mindful of when you're calculating some of these. However you want to calculate those, just keep those in mind. But then break evens is always a helpful number to just kind of keep, well, okay, based on all of my cost information above, I need, 323 to cover all the costs that I've included in there, including that cost of calves and feed, and it's the total cost of 323. We're at 325, so that's why we're at a slightly profitable number here. To just cover my variable cost would be 305 in some of the lean years, and you look at maybe perhaps if you're paying $2,000 a calf, you may be looking, okay, what do I need first to cover my variable costs, which is all of those, things that are more directly linked to the production of veal, like calf prices and feed. What do I need to cover those? And what do I need to cover my total costs? So both are useful numbers in trying to make some decisions or getting, some informed information to let you know what some of those break-even levels are. This risk assessment then is, it's based on those best case, worst case scenarios that you did up front there on the risk factors. The bigger the range, the higher the risk in an enterprise. So we saw the big range in calf prices. So that's why we're seeing this as it's taking a statistical measure, coefficient of variation to kind of, make that risk assessment. But essentially, if you have a really big range between the possible outcomes, then it's going to say it's a high risk. But if the ranges are very tight, then there's less risk in the operation. So you'll be at a lower risk or a moderate risk level, where this, mainly because of those calf prices, are a big piece of why it's listed as a high risk, just because those calf prices can be so variable from that side of things. So a risk assessment here just kind of gives you a bit of an idea, and there's some helpful calculators here. So, to break even, it's a 50% chance to break even. But if you said, okay, what if I want to make $100 a calf? What's my, probability of doing that? And it'll calculate those. So you got the 47%. Essentially kind of doing the same thing here, but just giving you some set ranges of, you know, I have an 83% chance of at least losing $1,000, right? And then it goes up from there. So to make $1,000, I got a 17% chance based on all of those risk factors and the ranges that we're talking about. So it gives you a little bit of a risk assessment, and you can kind of have an assessment of what that risk portion is for you. Another little calculator on the bottom here is, you can start making some assessments. Okay, well, what if I'm paying $2,200, 100 and you can guess what's going to happen to this, expected return per calf if I put $2,200 in here. And it's assuming that you've done everything you can on the market side of things and the cost side of things. So just changing the calf price, you see a significant change in that expected return per head, right? So not a big surprise, but it does give you a bit of a calculator here. What if calf prices went back down to 500? What are what can be some of the impacts of that? So it just gives you sort of a quick assessment, but certainly from your perspective, and like I talked about, the dynamics between calf price and market price are such that it it is helpful to to look at both together, right? So, you're looking, okay, well, if I have that, if I'm spending $2,000 a calf, see, there's my return to calf, minus 900. So, and that's at 325. So now you can, again, apologies for scrolling. There's really no other way to do this piece of it. But, if I'm paying $2,000 a calf, what does that do to my break evens down here below? So you can start seeing, well, I need to be getting 449 for my calf. And I need at least 430 just to cover my variable costs. So it is one of those, this is independent of the market price. This is just, okay, these are my costs. This is what I need to cover my costs. And at $2,000 a calf, you're looking at 449. So it's significant, right? To be thinking, and then you always have to be thinking, okay, well, is that realistic to think that market prices will be hitting that kind of level? But those are the things that you gotta need to be thinking about when you're looking at calf prices at the $2,000 mark. So it just gives you that ability to make those assessments. So some of the other things that I just wanted to talk about here was on the looking at what factors have some of the biggest impacts uh, on the economics of veal and on my cost of production for veal. So if I am at, if I start looking at, okay, what about a 10% change in a factor? What's the impact going to be on my return per calf? So if I look at, if my calf price went up, 10% to a little bit more of, $1,300. If you look at that return per calf number up here of 13, how is that going to change that? So it goes down, 130, 140 dollars for a 10% change. So that, if we go the other direction, a 10% change, a reduction in that, if you go 1185 times 0.9, so then it's, $140. So a 10% change in the purchase price is having about a, 150, $140 change. So it gives you, okay, well, small changes in that purchase price is going to have a big impact on the return to cash. So it's just a matter of, identifying some of those big risk factors. So if we do the same thing for market price here, so if we say, okay, if my market price is 10% higher at 358, I think the market price last week was 347. So it's not too far out of the way, but a 10% increase, if we look at that, keep our eye on that $13 a calf at 358. So we're looking at, a $250 change in the price. So obviously 10%, smaller changes on the market side of things have a big impact on the economics and the profitability of the operation. So that's, certainly those things, again, you may not have as much control over that market value or the market value piece or those, but it's just good to understand what the impacts of changes are when you're trying to make some of these purchase decisions, because it can have even small changes in purchase price or market value can have a big impact on that profitability, whether it's up or down, right? Some of the other pieces here, grain, corn, again, so if we said, okay, if our corn price went up 10% to 288, if we just look at, to save the scrolling, we just look at that feed cost number here of 555, what does a 10% increase in corn price do to that? So for 555, we're at 574, so roughly about 20% or $20 a difference on the calf sold. So your cost of production goes up $20. So that's going to have obviously a direct impact on the cost of production. So you can start playing with the numbers that way. So you got I think we have 262 before. I think that, yeah. So you can start seeing what some of these impacts. I mean, if grain corn goes up, maybe some of these others will go up as well. So you have to keep that in mind as well. But just understanding what some of those risk factors are. The price of, if just the price of grain corn goes up, it has, it would take a far bigger increase in the price of corn to have the same impact of a 10% increase in purchase price or a 10% increase on market value piece of it. So the last piece that I wanted to talk about as far as, is looking at production factors. Again, on the feed side of things, trying to reduce that average, or increase that average day of gain to reduce the amount of days on feed. You can make some of those changes, but if I just wanted to highlight here, if I said, okay, my optimistic was 2.1 and 4.5. So if I put those numbers in here, what does that do to my return per cap? Very little, right? And it's not to say it doesn't have a big factor. I just wanted to point out here is that when you're changing any of these numbers, there's going to be changes in other areas. It's not as linear as a change in corn price or a change in market price. You're going to have less feed fed. You may be feeding different things. You're doing different things to be able to achieve those better production factors. So when you're looking at, maybe my death loss, if I decrease my death loss, well, you're doing things production wise that are going to allow you to do that. So what are the changes on the production side of things that allows you to get to better production factors? So just keep that in mind when you're looking at production factors, is that they will be impacted by other things. So it's not as linear as some of the changes in input prices or changes in market prices. So that's some of the ways you can use the tool, and that's sort of the beauty of the tool is you can make all of these changes, and the idea is to have all of your own numbers in here, and then you can start changing these numbers and seeing what those impacts are and trying to make decisions based on this information. So that's the COP tool. One of the other things that I've often got was people asking whether, I have my income and expense information in this format. It's hard for me to put it into this budgeting tool format right away. Like I'm just trying to get an assessment of what my cost of production is for my operation. I don't necessarily have all of these factors to be able to fill in the complete production picture. I have my income and expense statement. Is there something we can use to kind of get to give us a ballpark or give us an idea of what the cost of production is for our operation? And so we did put together another tool called the Farm Financial Analyzer, which then takes your income and expense information, and the only production information that's asked is the per unit numbers that you want the cost of production reported on. So it, the main input is on this revenue and cost input page. So we'll walk through the tool here and show you first the cost of production pieces, and then there's some added things that the financial analyzer and the planner that we can look at as well. But here, what I did is I basically took that information on the veal budgeting tool, dropped it in here, but put it into the income tax format. So this will be, based on, your typical income tax forms, T1163 or 2042, whichever one you're using, or Statement A for agri stability if you're using those. So it's just putting I just dropped it in here just because, it's sometimes easier to see the use of the tool or how to use the tool if there's some already numbers in here. So you've got your farm name here, the year you're wanting to look at, the the enterprise that we're wanting to isolate here, and here's where we enter the whole farm numbers from our income and expense statement. So here we've got cattle slaughter. I think it's a little over a decade ago, they took away the veal commodity code, so you don't have that anymore. So it is, you're putting it into the beef cattle code. So, but it does give you the option of entering these commodity codes, and you can, choose any. It has every commodity code that's available for a farmer to put in. So you can scroll down and get to, where you need to be, cattle or calves from that standpoint, or you can start typing things in, and it'll start, enter, and then it'll the commodity code in there. So a couple of different ways you can start entering those. If you, for example, also grew some soybeans, $50,000 of soybeans, but none of it was for the veal operation. This is where you're going to start doing the allocations. This is all the veal operation, so 100% of that goes to the veal. but none of the soybean sales are going to go to the veal operation. So you just 0% goes there. So you do all of that for all the commodities that you have in here. If you got some crop insurance, again, it's modeled after the form, so it's pretty well exactly what you would be reporting on your T1163 or 2042 to come up with your gross farming income. I don't have anything else in here. It's just that strictly that veal budgeting tool information in here. But if you do, you just enter all of those and allocate as you need. Then you get into the expenses side of things. Again, is similar on the, there's a crop commodity section and a livestock commodity section. Similar, you've got the full commodity list here. Or, you can start just typing away. So if I've got some soybean seeds that, about $5,000 in soybean seed, but none of that goes to the veal cattle. So you can make some of those, but then, we bought these. This is a striking number, the 785, and that 650 model. I think we spent $90,000 in 2019, which is now for the same number of cattle, it's 785,000. So it's the magnitude is pretty staggering on when you're looking at between the two numbers. But then going through all the different other expenses here, again, if you've got some fertilizer here, I spent $2,000 on fertilizer for the soybeans. But none of it goes. You can just do those allocations and then you enter all of those straight from your income and expense form. And then you've got the, the net income and revenue per, for the whole farm. But then it isolates whatever you've allocated over to the veal operation. So this is your total numbers here on a cash basis. You'll need to do the accrual adjustments, change in livestock inventory. What did you have on hand at the beginning of the year and at the end of the year, and map that change to be including those accrual adjustments here. If you're in agri-stability, there is a claim form that will have that information on it. If not, you'll have, perhaps have that in your accounting software, some of the accrual adjustments that could be made to get to an accrual financial statement, because this is strictly on an income tax basis, cash basis. And so you need to get to an accrual basis. You need to add these accrual adjustments here. And then here's the only production information asked for. Veal is a little different. You don't really have a production unit per se. It could be, by barn space or by facility, that side of things. But, if you're on an acre and bushels of corn, it's a little more linear in there, but you can, this is just choosing what I want my per unit basis on. So here I've, just taken from the numbers from the budgeting tool. We sold 586 calves and, that came out to 442. So that's all of the input information here, straight from your income tax information. And then and then it goes through the cost of production report. So it basically takes everything you entered in the other one, but putting it on those per dollar per calf sold basis, and then dollar per pound of calf sold. So, these are the numbers, but you see here, it does pick up the soybeans, but there's no income associated with the soybeans in the veal operation. So it's zeroed out there. So it doesn't calculate those, but all the commodities that you've entered here to get to your revenues are $2,400 a calf or $3.25 a pound of calf sold, and then goes through again all of the different expenses on a per calf sold and a per pound basis to come up at the end of the day at sort of what that net income was for the operation. It was, I rounded a couple of the numbers off, so that's why it's $2 different than what the budgeting tool is, but this gives you that ability of taking your historical information and just entering what you have on your income tax forms and putting that into this format. And the format here, when we talk about annual cost of capital and EBIT, earnings before interest and taxes, all of these terms are defined in, we have a definitions page here that you can go to the definitions page and it'll explain what is included in those and how it's broken down, but it is on a standardized record keeping format is what we've put these into. So it summarizes the costs into five different um, cost categories, and we'll talk about that in the financial analyzer. But this is just, sort of quick COP tool that allows you to calculate that COP. And then on the farm financial analyzer, this is where, it combines your total costs into, these cost categories, which are all defined in the definitions. And so then it's all states it on a dollar per revenue of farming operations. And why we do that is because we do have some benchmarking information. We don't have veal, partly because we no longer have a veal commodity code. But we do have in other sectors benchmarks that we've driven from some of the agri stability business risk management data. So if you're a big feedlot, you can have a look at, sort of what the average results are for those, and do some comparisons. Beef feedlot would be the closest to veal, so that's why I chose those. But you can do some of those comparisons. So how you read this is, for every dollar of revenue, 83 cents to goes to those cost of goods sold. And that's more the direct inputs like the seed, the fertilizer, the feed, the calf purchases. But it gives you that ability to, kind of map out and see sort of what those, comparison to the benchmarks, or just comparing year over year. You can see what those breakouts are by those specific cost categories. So it gives you that ability. And then on the planner side, so this gives you a bit of an idea and allows you to have a benchmark comparison if you have a benchmark in there. But then you can also do some planning, use it for planning purposes as well. So if you wanted to start looking at 2026, uh, you know, and I want to look at calf sold, and I'm looking at maybe selling 600 calves and $2,500 a calf, then it'll calculate based on your historical results what that would be on a dollar per calf value if you were at the same level as you were in the past. So a $2,500 calf, you'd be spending $2,000 on cost of goods sold, and and all these other different categories, and the end at 1572. So you do some planning. If it's $2,000 a calf, what's it going to look like, and what some of those different things that you're looking at from that perspective. And then it based on the benchmark comparison, it'll calculate those numbers for the benchmark farm. So it's all farms in the data, and then the top farms by profitability is what the comparisons are. So we do have that. The biggest thing that I wanted to show you was the cost of production. So you can do that for your individual uh, operations on a historical farm basis. So you've got that ability to do that based on the input here. So that's just another one of the tools that we have available to you. So it is available on our website. If you go to this ontario.ca ag business, all of the links to the decision calculators and the cost of production tools are there. So I thank you for your time. And if you do have any questions, feel free to contact me if you're looking for more information. So Patrick, that's all I had. I'll pass it over to you.
Thank you, John. Your presentation offered valuable insights to support veal producers as they navigate market uncertainties and plan for sustainable growth. The cost of production tool will be very useful for both current producers and new entrants looking to strengthen management, improve profitability, and access new opportunities. As John mentioned, the veal cost of production tool was updated in late 2025 to help producers calculate their annual costs and support planning. You can find more information on our website, along with the links to the English and French versions of the tool. We encourage you to check it out as you develop your business risk management strategy. To our viewers, if there's anything you would like clarified, expanded upon, or have a question about, please email us at events@vealfarmers.ca, and the responses will be shared in the Finishing Grade Fed Veal in Ontario private Facebook group. Thank you for watching, and be sure to visit our website, vealfarmers.ca/on-demand, to find more webinars in this series.